we have no idea what the settlements are for, right? They could be exactly what he's saying, that they're paying out so much money, um, and they just don't want to get caught, so they're willing to settle. They don't want to go to court. It could be that they're just settling because it's cheaper to settle. Just go the hell away. I'll pay $5,000 for a settlement. You can say you got a settlement. We won't object to it, and this saves us money.
So yeah, let's get going. Hello everyone, welcome to another episode of Chatter. Today I am delighted to be joined by Brandon Kochkodin. Kochkodin? Kochkodin. Oh, like almost like Kochkodin. Okay. Brandon Kochkodin, who writes for Forbes as a staff writer and is the author of an article that I'm sure many people have read who are listening to this, The Loony Conspiracy Theory Threatening Wall Street. So Brandon, welcome to the show.
Yep, thanks for having me.
No problem. So as I mentioned before we started, I first came across you because I read your article and felt like you were giving a mildly different opinion, shall we say, to the one that is expressed by many people who have been following the GameStop saga. So I guess maybe we start with the article. So, and maybe actually we sort of rewind a bit and start with GameStop. So when did you first become aware of this as a story, and what was your initial take on the whole thing?
Yeah, I mean, for GameStop specifically, I mean, pretty much, late fall, early winter of 2019 going into 2020. So, a little bit beforehand, but, I was at Bloomberg at the time. And one of the things I kept doing probably since 2017, 2018 was, I got a little bit addicted like everyone else to Wall Street bets. And I mean, I was on there every single day. And, one of the things we obviously do at Bloomberg is, why is this stock moving? Why is that stock moving? And, it occurred to me, like, these same stocks, we were sitting there wondering why they were moving, and we didn't have a good explanation. You could look to Wall Street bets, and you could basically say, like, look, they're talking about these stocks right now. They're trading options, which means that, they're going to have a bigger impact, presumably, than what you would normally think retail would have. And so for years, I was just like, yo, this thing that you don't think is doing anything is actually moving stocks. Not a lot of people wanted to believe that at the time, but when GameStop happened, it was like, oh my God, maybe you were right about this.
I wonder, actually, on that note, do you think that it was actually the retail investors who were moving it, even if they are buying options, or was it like larger financial firms, hedge funds, etc., who were watching Wall Street bets as like a tip, just like a rumor mill to watch tips from? Because I get the feeling that they've been watching Wall Street bets, or they had been, I don't know if they still are, much longer than a lot of people realize. And for example, there was then, straight after the GameStop run up in January, there was a lot of tickers that were being hyped as or being identified by analytics firms as being ones to watch, and it turns out that they were just being made up by people, but they were being picked up because people were just spamming them on comments on posts on Wall Street bets. Like, there was one that was CUM that appeared in analytics firms as something to watch. That's always the one that just cracks me up. So yeah. I think so. Do you think it was the retail investors specifically, or do you think it was like the larger firms watching this?
I mean, I think it certainly was a mix of both. I mean, there's no doubt that professional investors tap into things like, the idea of message board stock chatter wasn't invented by Wall Street bets. Like, this has been an ongoing thing. So, like, I think definitely, and we're starting to see, after the fact, certainly, we started to see evidence of like, well, there was actually some, professional money involved in this. So like, yeah, I mean, I think it was definitely both. And it's like a question of like, do you think that some of the chatter on Wall Street bets was sort of fed into the system to create the hype? Or was it the other way around where like, hey, there was this retail chatter and then the professional money, you know, monitoring the feeds, it was like, okay, we're going to jump on this as like a momentum sort of trade or something like that. Like, I don't know how exactly it would have, actually played out, but yeah, there's no doubt. I mean, I'm sure professional money came in and, you know, made their killing on it as well too.
Yeah, I mean, I've no doubt that there was, and I think there's definitely an extent to which you could be right about there things being sort of like thrown in to Wall Street bets, like possibly even the GameStop thing by some like bigger sharks. But
Yeah, I mean, at the time, like one of the things I said during interviews during that time period was, if you went and you read some of the original analysis, like even prior to Roaring Kitty, like there were people on there that if I printed out their page on, what they were writing on Wall Street bets, if I printed it out and I put it on hedge fund letterhead, you wouldn't have known the difference. Like it was legit analysis. There was a guy, it was like the Loony D or something is I think the username I called out in one of my articles. And he nailed it. Like he nailed every single part of it. And that was like a year ahead of time before, all hell broke loose. But I mean, he was like spot on with everything. He nailed the fact that Wall Street was underestimating the cash. They were overestimating the cash burn, and it was like a traditional 100% value play, and they totally nailed it.
yeah, I mean, so Roaring Kitty first bought in I'm just looking for the exact date in 2019.
Yeah, I want to say it was
Yeah,
like August,
he
August or something like that, 2019 or July.
August
His like
2019
first
when he
post.
first, yeah, that
Yeah,
was his first post, but that's not when he
yeah,
first purchased it.
yeah.
In June 2019 was when he first bought some. So yeah, so he was miles ahead of the time. But yeah, his analysis was initially it was everything was based on the fundamentals. Like the short interest was not part of
Yeah,
the fundamental like value. Like his thesis on why the stock was undervalued. Like the short interest was nothing to do with that, right?
it was the cherry on top. That's like what it was. It was like, and if all of this plays out, hey, guess what? There's this fuel for the fire to burn even hotter.
Yeah. Then obviously things happen. People start realizing that he's maybe right. Around September 2020, the short interest was already at 120%. And then it depends on exactly who you believe in terms of numbers, but it was somewhere between 140 at one point, all the way up to about 282% in mid-January was one of the highest figures I saw quoted by an analytics firm. So the thesis of your article is basically that naked short selling is not massively, it's not something that's widespread within the market at all, and it's definitely not the reason for companies going bust. So you've cited a few examples in the article, and we can go into them. But how do you think a stock gets to that level of short interest without some amount of naked short selling occurring?
Well, I mean, I guess the first thing to point out here is if we're citing numbers that are that high, that's that's not based on naked short selling, right? Like you wouldn't have the number. Short interest wouldn't be that high if there was naked short selling, right? Like it wouldn't account for naked short selling is what I'm trying to say. Like the naked shorts wouldn't factor into that part of the equation. So when you cite those numbers from like the analytical reports, whatever, wherever it's coming from, S3 or whoever, like that's legit known borrows.
Hmm.
And that's also why we know the borrow number or the expense to keep borrowing got so high. In terms of like how it gets that high, how it can go in excess of 100%. Matt Levine, if I forget when this was, but it was probably during the whole mayhem in January of that year. he wrote a good column explaining it. It's that, shares can be lent out multiple times. I can lend it to you and then you can lend it to someone else, and that counts, and that you can keep adding to the numerator. I mean, it's a chain. It's really weird to think about. But it happens, and like it rarely doesn't happen that often. But if you can't get the shares, and this borrowing it keeps happening, it can go over 100%, and that's what happened there. I mean, I again, like it's one of these things where people say naked short selling, but like, where's the evidence? Like, I understand why people would think that, and certainly in a case where the borrow rates got as high as they did for GameStop, like that would be a situation where you would expect it. Like, if there was ever a situation you would expect it, it's when the borrow rates go sky high, because why would you want to pay that? But I still haven't, again, still haven't really seen evidence for it.
Mm. Okay, so you're saying that even so a lot so in my mind there's two instances where there's the I would consider something to be a naked short sell, and you can correct me if my understanding of the definition is wrong. So either under reg show rules where a hedge fund will go to a broker and call them up and say, look, they'll do their locate, but they'll not actually purchase them, or they'll not borrow them like physically from them,
Yep.
and then they'll sell them in the market, and then either eventually they'll purchase them or they'll fail to deliver, or they just straight up don't even bother to do the locate, and then they just say, yeah, we've got this, we'll sell it.
Yeah, we've got it.
Yeah. So you're saying that if the analytics numbers from people like S3 and stuff doesn't actually include any instances where the stock isn't like legitimately borrowed, so that the locates under reg show rules don't count towards the reported short interest.
My understanding is that it should count for anything where they said that there was a locate. I mean, I guess I understand what you're saying. I guess presumably there could be a situation where it's getting counted in there, but I don't think that's the norm. Like, I would think that's kind of an exception to what's going on. Because then it would be sort of like, I just try to think about this, because here's the problem with the whole naked short thing, right? And people admit this, like, there's this black box that we can't see inside, and no one likes that. I mean, it wasn't long ago when we didn't even get fails to deliver data, right? So you kind of have to observe things. I think about it a lot as like, it's like a black hole, right? Like, physicists don't see a black hole. You can't actually see the black hole. You have to observe the effects of the black hole to see the black hole, right? And so you look for these things that are just a little bit off, something like that, to like guide you to the idea that this might be happening. If it was the case that it's these like fake locates adding to it, like that would be sort of obvious. It should be easy for regulators to pick up on, for whoever to notice it and to like pin it down. It shouldn't be so hard to find and prosecute these naked shorts, right? Now, of course, I know what the answer is to this when you bring this up to people, right? Like, they'll say, oh, they don't really care to find it, or everyone's sort of in on it.
Mm-hmm.
Obviously, I don't believe that, but but that's, I mean, this is the way I look at it. It's like, if it was so obvious that it was just this like fake locate driving up the short interest, like, then it would be easy. It should be easy to find this.
Yeah, I mean, so I guess the point that you make in the article there specifically is that you say that Wes Christian, who has represented, I think you said he's done 71 different cases, or he's taken on 71 different cases. I'll check that actually.
Yeah, I think it's like 20 some, but he said he's done research into like 70.
Okay. So he's taken, yeah, sorry, you're right. So he's litigated 21 cases and done due diligence into 21. Let me just bring this up for people to watch. And either the cases have not gone anywhere or they've settled, basically. So I think the point that a lot of people would make in counter to what you're saying is that, look, if this is a way that hedge funds use to try and manipulate markets and bash down the price of different stocks. Like they would just, the money that they're going to make off of it is nothing in comparison to the amount that they would have to pay to sell. So they're settling and just saying, yeah, we'll just get this off the table and we'll move out the way. Like, do you think that would be a legitimate thing that they, or well, not a legitimate, but could you foresee that happening? Because you're far more in that world than I am. You have dealt clearly with a lot more people in the financial industry and had a lot more experience in the system than I have. Like, do you find that to be something plausible, that they would settle a case in order to dismiss any discussion of it?
Okay, well, let's start at square one. We have no proof that these cases are settling, right? Like, basically no proof. There's 20 some cases. They're all private. Like, he's saying that these things settle. We have absolutely zero knowledge. I mean, there's like one or two where you can see that there was a settlement, I think. But for the bulk of them, we have no idea if there was a settlement or not. So this is his word against no evidence being provided. Two, we have no idea how much they're settling for, right? People will settle for a lot of things, right? Like you could settle just because I could settle for $5,000 because I know I'm going to pay legal bills of $50,000. We don't know. Like, this is one of the problems about this. Like, we just have zero. As much as they complain about the financial system being a black box, this is also a black box. And then when you ask them for evidence, they do the same thing that they accuse the financial system of. And they say, oh, well, we can't show you because of X, Y, and Z. And there's privacy concerns. And these are our clients. And blah, 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 blah. They use the same exact things. But then they get on their high horse about the financial system and try to prove to be crusaders. It drives me insane. So anyway, we have no idea what the settlements are for, right? They could be exactly what he's saying, that they're paying out so much money, and they just don't want to get caught, so they're willing to settle. They don't want to go to court. It could be that they're just settling because it's cheaper to settle. Just go the hell away. I'll pay $5,000 for a settlement. You can say you got a settlement. We won't object to it, and this saves us money. It could be the situation you're saying, though, right? Like, I totally accept that it could be that situation where they're making so much money off this. Just, hey, hush, hush, be quiet. Here's some money, go away. But then, like, these people treat this like a crusade. This is us against the system. The system's corrupt. Okay. So then at what point are you actually going to have morals and, put up your values and say, wait, no. The point here is to fix this problem. And we're going to go to court and we're going to put this out in the open so everyone can see it. Why aren't they doing that? So they'll say, of course, well, we have an obligation to our clients and, we get them the settlement. Okay, fine. But like, you can't talk about how you're trying to fix the problem if you're not actually taking steps to fix it. Like, if you're going to keep everything in the dark and you're not going to present your evidence to the world, you're not going to show people, hey, here's 100% proof that we got a settlement and it was because of this, and this is how much we got. I mean, I don't understand why people take this as like, look what he did. He's won all these cases. He's got all these settlements. No one knows. I don't know a single person who knows this, who's willing, or has the evidence, can prove it. So I don't know. I mean, it's kind of pick your choice, but I think, my two options are more logical than the third one.
Yeah. So then in the case of GameStop, I think some of the evidence that people are looking at in terms of trying to say there are hidden shorts, basically. So if, as you're saying, like, the naked shorts aren't like listed or technically measured, if they exist, by the analytics firms, there's things that people point to in terms of, so I don't know how closely you've been following the stock. So basically, about 3 months after, so January 2021, the price went from right down at about, I think it was like $15 in the start of January 2021, about $4 about 3 months previous to that. But it spiked all the way to 481. The buy button was turned off, and the price crashed to $50, right? But then after that, the next couple of days, the price sort of spiked back up, got to about 280, I believe, 300, then went down. Then about 3 months later, in March, it ran the whole way up to 350 again. out of nowhere. People speculated that was people finally closing some of their short positions, and then once again, like out of nowhere, it just crashed. Like this was not based on like a massive amount of retail buy-in, from what I can tell, because everyone that had sort of bought in had bought in. Okay, some people were buying more, but there was like other players involved, and then a couple of months later, something similar happened. It got all the way up to about 290 again, and then dropped again. And sometimes people look at things like this and then they'll read articles like yours and see you're sort of railing against this idea that like the market is rigged, and you made me laugh with like your calling it like QAnon levels of discourse. But like people look at a lot of these things and go, well, look, what on earth is responsible for this like yo-yo in price action? Like there's nothing in available data that seems to suggest why, aside from some really like esoteric, like strange, like financial instruments that people are drawing like things between. So for example, there was a lot of suggestion that failure to delivers can be sort of erased using deep out the money puts and some sort of other options contract to like swap something in. There's been suggestions that like ETFs can be used, things like XRT that had like a massive portion of GameStop shares in it, which at one point was shorted like 5,000%, like something obscene like that. And then I've got a whole other list of things I could list off, like things like the self-regulatory nature of the DTCC, payment for order flow, the way high-frequency traders can sort of access the market faster in order to like scrape money off of trades. Even back to like synthetic CDOs in 2008 actually being a real product that people bought, just like derivative contracts made up of derivative contracts. So do you like, to what extent do you think, I know this is a long question, to what extent do you think like there is the market is like a fair and free market? Because it looks to a lot of people who first became exposed to the world of finance through the GameStop saga, like there is an awful lot of rigging going on in the market. So like do you think that's a fair statement, or do you sort of disagree with that?
Um, I mean, certainly we know weird things happen, things that shouldn't happen. Like, look, I would never sit here and say it's like perfectly clean, right? Like, I tend to think more of the dirty things happen, like not in the actual trades themselves. Like, it happens in other places, like through the IPO process and things with warrants and like I don't know. That's where I usually think most of the corruption and weird stuff is happening. But in the actual like day to day trading on an exchange, like I don't know. Like I'm sure that, like there's definitely like it's not perfect. I'm totally aware of that, but I don't think that's usually the place to look. But I mean, who knows?
Fair enough. Um, so I guess the next question I would have would be based on that.
Well, I mean, I guess the other thing to say is like just citing that GameStop example. Like it's very clear that after that, you know, fall run up, it became divorced from the fundamentals, right? Like there was a certain like forget the short interest for a little bit, right? Like just where the price was going, I think in fall, early winter of 19 into 20, like there's a certain point there I think anyone can look and say, like, look, this obviously wasn't trading on the fundamentals anymore. Like it more than surpassed what it should have traded on fundamentals. Um, and obviously there was obviously tons of short interest. That will explain at least one of the run-ups. The other ones, like, I don't know. Like the most logical explanation to me just keeps being like, this was a stock that was talked about. There was this, you know, there was this community, whatever you want to call it, around it. There was this herding behavior that it would run up again and drop, run up again and drop. And certainly like, well, the stopping the buy button thing was ridiculous. Like I think everyone, I don't know anyone who doesn't agree. with how absolutely ridiculous that was. Um, but but like it seems like there's an explanation, or at least gets you like most of the way there, just in understanding like it was just crazy. Like we've never seen anything like this. It was divorced from the fundamentals anyway. Like no one really cared how high the price was going. Like people were saying diamond hands don't sell. Like these are not normal things. So to see not normal behavior, like totally not normal behavior, like people saying that they're not going to take a profit at any level that was even remotely plausible, or maybe not plausible, but like defensible from a traditional fundamental standpoint. Um, that's a setup to get crazy things happening. Like that seems more logical to me than there's a million different nefarious things. But I mean, I don't know. Like, look, there could have been. Like, there could have been. I have no idea. But the naked short selling thing would have been. I don't know. I mean, like, I keep thinking in the GameStop instance, like I said, if there was a place where the setup was perfect for it to happen, but with the borrow rate being so incredibly high, like that's the perfect instance for naked short selling because you're trying to get around having to pay the borrow. Um, but you know, we can we can complain a lot about the way Congress and regulators handled the situation, but the fact is they did haul these guys out in front and put them on trial essentially in front of the public. And it seemed like they were eager to do something. There was certainly a political will to do something. Like, if you watch those hearings, like members of Congress were like chomping at the bit to like get a part of get a piece of these guys. So if there was evidence of naked short selling then, and you would think FINRA or the SEC, DTCC would have had some sort of proof. That was the time to go after it to do something, right? Like that's the one thing I don't get. Like they were in the crosshairs. There's no doubt about that. Vlad especially was in the crosshairs. But Ken Griffin certainly got dragged up there. Like if there was a time to go after them, if there was a political will to do it, you would think that would be it. So, in one sense, I'm saying that as like evidence for my kind of perspective. But I understand why people look and they say, well, if they wouldn't do it then, they're never going to do it. So like I totally, kind of shooting my own evidence in the foot a little bit there, but I get it.
I mean, like my with my cynical brain on, I would say, well, a lot of these people are looking for to go after them because it was the thing of the moment, and their staff probably went, hey, you'll get loads of good press if you say this, this, and this, without any actual desire to go after them. Um, I mean, I've spoken to people who have different opinions on Gary Gensler's work at the SEC. Dave Lauer, for example, thinks he's doing a reasonably good job within the framework he's sort of working within. Suzanne Trimbath, who you cited in the article, seems to think that he's not doing a great job and could do a lot more within his sort of scope of power. But I don't know. I again, my cynical hat on, I feel like the cost to their future careers as advisors at financial services boards, or straight from the SEC into, say, Robinhood or Citadel. As we've seen, like the pathway totally exists. People do it. There's quite a few people work at Citadel and at Robinhood, just to cite like the two people involved in the GameStop thing, who like came straight out of the SEC. I think they waited the 3 months exactly that you have to wait, and then straight into a job like at this, and it makes me skeptical that they would do anything. And
that's totally fair. I mean, I guess the one thing I would say is like, if there was ever a time though that you would think someone would want to go after them, Gensler is pretty well off. He did his time at Goldman. Like he never underestimate anyone's desire to make more money. And like, but I think by all accounts, he's worth over $100 million. Like, again, I will never say that someone, even worth $100 million doesn't want to be worth 200, 300, a billion. but man, like you would think that would be the opportunity to have someone that's already made it, who's been at the top of the heap financially, who doesn't need a career beyond this. And it's sort of like, by all accounts, he's been trying to angle for Secretary of the Treasury to get like a real nameplate job. You would think he would be the one to go after it, but you know,
Yeah.
who knows?
Yeah, I mean, I feel like the FTX Sam Bankman-Fried example sort of proves that money in the right pockets can mean no one's going to look at you too closely. Um, but like just for interest for you, actually, I'm not sure if you'll find this, but some of the cost to borrow things like after the January run up, long after. So March, the max cost to borrow according to Ortex for GameStop was 87%. On in May, Vortex was they were reporting a cost to borrow of 301%. Yeah, and there's a couple other ones through that month. There was one day it was 231, another day it was 325. And yeah, it's these there's sometimes the just astronomical figures involved, and like watching this whole thing. And again, this is the one of the reasons I wanted to speak to you is because like you have far more like time looking at different stocks and tickers than I probably will ever have. Um, but one of the things that people have seen repeatedly through this and sort of highlighted is like glitches in share price, like share prices being listed in terms of like shares available to short, in terms of like the ticker doing weird things, like the different like orders coming in that are saying like they won't accept anything below like 10 million for a share. Like there's been countless examples. Like I couldn't I would need more than a book to fill with the amount of glitches involved. Like, is that just the financial system? Is there just like is there so much information and data being thrown around that like these glitches occur on tickers and on like in the way things are reported and stuff?
Uh, yeah, I don't know. I don't know. I'd have to look at some of these specific examples. I mean,
Well,
not none of those like specifically ring a bell to me as anything I've ever looked into. But you know,
yeah,
um,
this is what happens when you have, and this is what happens when you have like 100,000 people constantly looking at one ticker. You know, they find things that you wouldn't expect. Yeah, I'll find some while we're talking about the next thing. I've got them somewhere in this document. So, like the other thing that I want to sort of ask was, what do you make of a lot? Basically, so through writing the book, like I've come across a lot of examples of, for example, Citadel, who last week were charged with marking shorts as longs and longs as shorts and just market trades incorrectly. They were fined 7 million. That is one of countless examples where financial firms have been fined small amounts compared to the amount that they will have made off of their apparent mistakes. Do you think that is a reasonable way to conduct for a regulator to conduct themselves? Is like, or would you say that like being harsher is going to be detrimental to the market generally?
um, well, I guess the first thing, like the I'm not sure that we actually know the financial harm from like the Citadel one from last week. Like,
Yeah, I
I
mean
don't think
that
they're,
specifically, it's difficult to tell what the financial harm is in that case. I mean, if you
yeah.
were to go full crazy, you could say that they were marking all of their shorts as longs through the entire GameStop saga and getting away with having far more shorts involved than, you know.
Well, but even at that, like there's a difference between like there's the press release and there's the order, right? In the press release, and that one specifically mentions reg show a bunch and protecting from illegal naked shorts, but then the order doesn't really talk about that. Like when you read the order, it's like it makes it seem like it's mostly a bookkeeping issue. Like they don't seem to be saying like that, hey, this caused phantom shares or anything like that. Like they're basically saying like this screwed up the integrity of the data that you're handing over to us, and so we're fining you for that because you've agreed in order to have all of your certifications, blah blah blah, that you have to have accurate books, and you didn't give us accurate books. Like they don't seem to be saying like this caused the phantom share issue, that it caused any of this, and like they don't. I don't recall seeing a number in there on the financial harm. So like it's hard to judge whether it was a big fine or a little fine. Like I don't think there's the context. I don't think there's context for that. First off, um, but like generally speaking, the way the SEC has gone about things, like I recommend people read. There's a book called The Chicken Shit Club, and it was written about how the SEC has gone about enforcement actions since like I forget when they say the turning point was, like 2002, 2003. But he makes a very persuasive case for like, hey, these sorts of fines, not going after criminal, not doing criminal procedures, going strictly after fines, taking settlements was supposed to be sort of a one-off affair because there was a couple cases back. I forget the specific case, but basically saying like, yeah, they didn't really have enough information to go on for like a full sort of like, to recommend criminal charges to like FBI, stuff like that. And so they took this as like kind of an out. I think it was like Mary Jo White back then. And um, what was supposed to be an exceptional case and going for settlement became the norm. And he lays out, and some of the things he lays out in that book are like, yeah, there is this revolving door. We all know about it. We all know it's a problem. Something should be, something should absolutely be done to shut the revolving door, like make it much harder to get through. Um, but yeah, I mean, reading that book, like you do come away from it thinking like the SEC is not doing the right thing here, that they should actually be prosecuting individuals. Like that, to me, that's more important than these fines. Go after actual people here. Like no one, they don't, they didn't go after anybody in 2008. Why not? Like it sure seemed like there was criminal conduct. So, I mean, if I was king of the world type of thing, that's what I would push towards. Like go after actual individuals. Don't give them this indemnity to like work behind corporations and have a free for all.
Mm, yeah. I mean, yeah. But again, that sort of goes back to what I was saying earlier about money in the right pockets. Um, and the seriously, severely under resourced SEC, given how large the market is in terms of like percentage of GDP. It stuns me that like not only are the SEC constantly saying they're under resourced, but that like a lot of the work is then outsourced to self-regulatory bodies who have every incentive to not say anything because then that invites more questions. The last thing I wanted to ask about was I'm not sure. Are you familiar with some of Matt Taibbi's reporting on the 2008 crash? So he's very convinced that naked shorting was used to kill both Bear Stearns and Lehman, or at least give them the last push off the edge of the cliff. What do you make of that theory?
Yeah, I don't really buy it. I mean, it's been a while since I read all that stuff, but yeah, I mean, I got the sense that I don't think it was his best reporting. I like Matt a lot, but I think he got fed a lot of I mean, you have to remember he was making a lot of hay off the overstock stuff, right? Like he was getting fed by a person whose name I shall not say, information. Like I don't know, like we're questioning regulators being in people's pockets and stuff, and like it happens both ways, man. Journalists, like it's not usually a quid pro quo with money or anything like that, but like if you have a source that keeps giving you information, you're more likely to believe them, on the next thing they tell you and things like that. I don't know. He was really heavy on the overstock thing. I think that was all fairly dubious. I think there was kernels of truth there. There was obviously problems. Dr. Trimbath's book gets heavily into that. But yeah, I mean, I think if any naked shorting was happening there, it was like, I mean, I think the body was dead, and it was like the last bullet in a corpse.
Yeah, because I think people's suspicions about it comes from the fact that, as far as I understand, if you have shorts open, naked or not, on a company that then goes bankrupt, that you just get to keep the money that you'd made selling the shares, selling the shares short. That's a big mouthful. Tax free, as far as I understand, which is a nice little boon. So, I mean, yeah, as you said, it's the black box that makes it a problem. It's that we can't see into what's going on, and neither can anyone. That's the biggest issue. It's like, not that I believe that everyone should be constantly able to see everything, but I feel like there should be some sort of auditability of every trade that happens. And I guess maybe if things go blockchain direction, we'll get that, which would be lovely. But that might take a long time, given how difficult it is to unpick the current structure of Wall Street. Anyway, Brandon, I want to really thank you for your time, man. I really appreciate it. Is there anything you want to plug before we finish?
No, I'm all good. Thanks a lot, Josh. Really appreciate it.
No problem. Hey everyone, thanks for making it right the way to the end of the podcast. I love that you tuned in this long. Do me a favor, hit subscribe, because 80% of you bastards are not subscribing, but you're watching my videos. See you next time.